The stock market is hitting record highs right now, and if you're feeling like it's a little strange, you're not alone. With everything going on in the world, how is this even possible? Well, today we're going to break it down. We're going to look at the three key forces that are actually driving this rally, and maybe more importantly, the one huge risk that it seems like almost everyone is ignoring. Okay, let's just start with this number right here. That's the new closing high for the S&P 500. And I mean, that's not just a good day, that is an all-time record. The Nasdaq also smashed its previous peak. To put it simply, the market is on an absolute tear. So yeah, that begs the question, right? With all the geopolitical tensions, the worries about inflation, just the general messy state of the world, how on earth is this happening? It doesn't seem to add up. But trust me, there's a fascinating story hiding underneath these numbers. And if you dig into what the financial analysts are saying, this isn't just some random burst of excitement. No, this rally is being fueled by a really powerful mix of three very specific forces all coming together at the perfect time. So let's break down exactly what they are. All right, so driver number one. This is all about market psychology. It's this idea that the absolute worst-case scenarios, especially those intense geopolitical fears we all had back in March, are now fully priced in. The market has already absorbed that shock. I mean, think back to March, right? The market was gripped by fear. It was panic mode, and that led to a huge sell-off. Now, the whole perspective has flipped. It's like the market is saying, okay, the bad news is out there, we know about it, and because things were so oversold, now any news that isn't a total disaster feels like amazing news, and it sends stocks rocketing up. Okay, so that's the psychology. But what about the hard numbers? Well, that brings us to our second driver, and this one isn't about feelings, it's about cold, hard proof. This rally is actually being built on a bedrock of surprisingly strong corporate earnings. And look, this isn't just hype. You can see it in the data. Just take a look at GE Vernova. It soared 14%. Why? Because they raised their forecast, thanks to all the demand from the energy transition and all those new AI data centers. Even a company like Boeing, which has had its share of struggles, saw its stock pop because its losses, well, they just weren't as bad as everyone feared. The market is seeing real strength out there. And this really gets to the heart of it, doesn't it? What the analysts are basically saying is that these strong earnings, the actual money these companies are making, are what's justifying these high stock prices. It's giving investors the confidence that these valuations aren't just smoke and mirrors, they're backed by real-world performance. Now for our third and final driver. This one is really fascinating because it connects what's happening on Wall Street directly to Main Street. It's a classic economic idea called the wealth effect, and it's acting like a massive tailwind pushing everything forward. So here's the simple idea behind it. When people look at their 401k statements or see their home values at record highs, they just feel wealthier. They feel more financially secure. And what do people do when they feel confident? They spend more. That spending boosts company profits, and those profits, well, they push stock prices even higher. It becomes this powerful, self-feeding loop that just keeps the momentum going. So you've got fear already priced in, you've got strong earnings, and you've got this wealth effect all pushing the market to new heights. It sounds like a perfect storm of good news. But this is exactly where the story takes a sharp turn. There's a huge contradiction hiding in plain sight, a risk that the market seems to be choosing to ignore. So let's start with the good news, right? The big headline that really lit a fire under the market today. The word came out that the ceasefire with Iran was being extended indefinitely. And for the market, that was huge. It seemed to just erase a big cloud of uncertainty. But if you scratch just below that surface headline, you find a reality that's, well, a lot more worrying. And here it is. This is the piece of information that seems to be getting completely glossed over. On the exact same day that everyone was celebrating the ceasefire, 3 ships were attacked near the Strait of Hormuz, one of the most vital shipping lanes in the world. The conclusion here is pretty obvious. A political agreement does not mean the physical danger to global shipping is gone. That risk is still very, very real. So what do you do with that? You've got this euphoric market hitting all-time highs on one side, and this really serious overlooked risk on the other. For a smart long-term investor, how do you even begin to process these two conflicting signals? What's the right move? Well, what the analysts are saying is actually pretty clear. Stick to the plan. First, don't ditch your protections. Keep those hedges, like energy stocks, as long as that physical risk in the Strait of Hormuz exists. Second, keep your eyes on the fundamentals. Watch those big earnings reports, like the one coming up from Microsoft, to see if this AI-driven growth is the real deal. And third, maybe the most important piece of advice of all, do not make emotional moves. You know that feeling you get? That little voice in your head that screams, everyone's making money but me, I have to get in now. Well, that feeling has a name. In behavioral finance, they call it the S1 trap. It's your fast, emotional brain taking over. It is pure, classic FOMO, fear of missing out, and it is one of the biggest traps an investor can fall into. So, what's the bottom line here? For almost every long-term investor out there, the smartest, most rational, most effective thing you can do when the market is hitting a record high is exactly the same thing you did yesterday. Just keep making your regular, planned contributions. Don't let the screaming headlines knock you off your long-term strategy. And that really leaves us with one final thought. As the numbers get bigger and the headlines get louder, it's so easy to get swept up in the emotion of it all. So the real challenge for all of us is to take a breath, step back, and ask ourselves, are my decisions being driven by a clear strategy or by a momentary impulse?